What's the difference between active and passive investing? Hi, I'm Scott. I'm a certified financial planner, fee-only, fiduciary. We have offices in Austin and Houston, and we work with folks that are in retirement or planning to retire relatively soon. So first, let's define what these terms are. A passive investor is investment. Let's talk about it like it's for a mutual fund, not an individual, like a mutual fund firm. So a mutual fund would invest in an index, if you would. So it's not trying to beat the market, it's trying to track the market. So the definition of a passive investment is one that is tracking an index. On the other hand, an active investment would be from a mutual fund or an ETF, a family provider that buys. This is the traditional style. You say they buy, they sell, they're changing their minds, they're traveling around the world, and coming up with a lot of action. And an example of that, a passive, there's a firm called iShares owned by BlackRock. They have an ETF out that's called ITLT, and it's extremely large, low cost, and it's based on one of the indices out there. And that's a great example of a passive fund. You could just buy ITLT and have the entire U.S. market invested in, and you're done. On the other hand, there's an active investment would be an example would be Fidelity Magellan Fund. Rock star fund managers over the last 30 years. These guys are famous. They went on to manage hedge funds and write books, speaker circuit. These guys are literal rock stars. So and Fidelity kind of grew up as a active fund, mutual fund house. And that was their bread and butter, if you will. So the history of this is, we started mutual funds, 40 or 50, 60 years ago. And at that time, more or less everything was active. You hired a fund manager, they had research analysts, they had traveled around the world and trying to buy, Japanese banks, big tobacco in the U.S., finance, maybe oil. Then they'd shift gears and go into Germany or timber in Canada and, try to beat the market, try to generate alpha. Alpha is the term which is a return over a given level of risk. And so that was their objective. And then along came, that made it popular. Maybe they weren't the first, but they were absolutely the vanguard, if you will, of this industry, of the passive investment. And that's Vanguard and Jack Bogle. And again, what they did is have a passive style. So what that means is, let's just pick the S&P 500 and invest in that and keep our costs rock bottom and pass that on to our clients in terms of performance. And so there's been a big battle between active and passive. And then we had the explosion of ETFs in the past 20 years that have just really taken off. And the reason why is they're a lower cost container, they're more tax efficient, and typically ETFs are also very passive, so that they'll manage to a index. All right, so wrapping up, some of the pros and cons. The bottom line is active ETFs are, from an academic perspective, generally underperform passive, and lots and lots of studies show that. However, as more and more people move toward passive investments based on an index, that opens up a lane for these high-end managers to come out and find alpha on the side. So never discount active management, because there's absolutely a place for that in the future. So be aware, maybe you can have a combination of, maybe in the U.S. you're indexed, and maybe in the international market, emerging, maybe you go active. Anyway, it's an idea. So anyway, thanks for your time. Please like and subscribe, and visit Hamilton Financial Planning if we can be any assistance. Thank you for your time.